Hello, everyone. Today on the Final Bar, I'm talking to Ari Wald from Oppenheimer. He's one of the best in the industry. We'll talk about some of the charts that he has been sharing with clients recently, his take on this movement that we've seen in the market. Uncertain days, uncertain times for sure. A lot of choppiness, but the S&P, the NASDAQ having a decent update after yesterday's rally as well. The S&P up about 2%, the NASDAQ pushing 3% higher. Is this enough to signal the all clear? Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of technical analysis, using the StockCharts platform to better understand what's happening around us as investors, improve our, what I call our market awareness, our understanding of what's working and what's not. And I would argue charts are often the best way to make sense of things as they're happening. You know, a lot of earnings this week. I feel like we've said that a number of weeks. This in particular, it's sort of the big box retailers. So we have Home Depot, Walmart to talk about today, and that sets the stage for Lowe's and Target and some of the other ones. Can always be an interesting lens into what's happening with the consumers and what their behavior is, how that's evolved, and how some of these companies are trying to deal with things like supply chain issues and inflationary pressures and cost pressures. And all of that. Now, all of that are sort of the fundamental arguments. I would tell you that the chart tells you a lot of what you need to know. The chart of Walmart will tell you what their experience has been and what the optimism or pessimism may be looking forward as the stock gaps down, 10, 12%. It tells you about Take-Two jumping higher around 12%. AMD, one of the semiconductor names, up almost 9%. So the charts will tell you a great deal about the behavior of these stocks and the investors and what their buying and selling decisions actually are. The details as to why those decisions have been made often look way more clear in the rearview mirror. So let's focus on the charts today. We have a great guest lined up for you, Ari Wald from Oppenheimer. We'll talk to him here very, very shortly. Other great guests coming along the lines here through the remainder of this week. Tomorrow on Wednesday, the 18th, I'm excited to have Mark Chaikin from Chaikin Analytics. Mark is really a legend in our area of the industry, created a number of technical indicators. A number of us learned as we're getting started. Getting a chance to pick his brain a little bit on the show tomorrow should be fun. On Thursday, the 19th, we have Louis Yanis from WealthNet Investments in Colorado. Louis does a great job really bringing a financial advisor perspective. He works with a lot of individuals and others to make sense using technical and quantitative methods. Let's continue on with today's show, talk about this overall environment and what we're seeing, what we're hearing. Before we get to our market recap, I want to share with you a poll that we ran recently. So as a reminder, we always have a poll going on our live stream page at StockCharts.com, also on our social media accounts. So give us a follow on Twitter. You can follow us on Facebook, LinkedIn, and elsewhere. We asked you recently, what market environment do you find the most challenging? A bull market, a bear market, or a sideways market? I'm not surprised that 2 out of 3 of you said a sideways market. I would tend to agree. And it's funny that, and totally true, 5% of you said a bull market. I was told early on, never confuse brains with a bull market. When everything's going up, we all feel like rock star investment geniuses. We have an amazing investment process. Our attention to risk is appropriate. We ride our portfolios higher, we ride the market higher, and we are expert stock pickers. This sort of environment, that choppy, bearish to sideways environment, is where all the ugliness starts to pepper up, right? You recognize when there are gaps in your investment process. You see when you're holding on to things too long, when you're not holding on long enough. All of those issues that a bull market can smooth over for you kind of bubble up to the top. So we're glad you're joining us today. I hope we're able to help you address the challenges that you find in this sort of environment, because I would agree these are challenging times. But the good news is charts can really be an effective way of trying to make sense of some of those things. Let's continue on with our next goal here, which is to recap this market from today here on Tuesday, May 17th. The S&P finishing up 2%, just below 4,100. We've talked about some of those key round numbers. That's sort of when you revisit, what the S&P is doing when it sort of, changes to a new handle, if you will. And so 4,100 is an interesting one. Remaining above 4,000 is certainly a key one. That's a 50% retracement of September 2020 to March 2022. We so far are holding that. Let's see if that continues. The NASDAQ pushing up almost 3%. It was up a little more earlier in the day, if I remember, but finishing pretty strong. Actually, finishing at the highs of the day, just below 12,000, which is it's a good round number to pay attention to as well. Mid caps and small caps both outperforming the S&P, with the S&P 600 small cap index up the most, right around 3%. The VIX back lower, back below 30 now, so just above 26. That's an important data point, actually, because part of the, I would argue, sort of part of the bearish thesis, if you think about this market structurally showing weakness, that would most likely see an escalation of volatility. You'd see the VIX get higher and higher, but not too long ago, we were talking about 20 and 25 being the upper end of the range. Now we've gotten into the low mid 30s, and so coming down to 26. So the volatility's come off a little bit. Still pretty elevated relative to certain historical periods for sure. Interest rates back pushing to the upside today with 10-year yields around 297, a 30 yield well above 3%, up around 316. The dollar index down a bit, looking at the UUP down about 0.8%. And that bullish dollar thesis, which has been really one of the key components to 2022, I would argue, a big down day like today makes the chart look a little bit differently, but the overall trend remains fairly consistent. We'll look at that chart here in a little bit if I can make a note to do so. Continuing on, gold down about 0.6% using the GLD, silver flat for the day, and overall commodities a little bit weaker. The energy sector, not one of the best today. Technology materials really outperformed pretty well there. Finally, cryptocurrencies finding some sense of stability, but that's stability in air quotes, not actual stability, with Bitcoin settling in around 30,000. Talk about a big round number that has come into play many times. Look at the chart of Bitcoin, just draw a line at 30,000, 20,000, 40,000, 50,000, 60,000. We'll have identified many of the major turning points over the last 12 months, and I'm not kidding. So I'm not surprised to see the 30,000 level kind of coming into play. With Ether, 2,000 is an important level that we're at this point remaining above, which is key. We're trading below there actually yesterday. Let's look at a chart of the S&P 500, just get a sense of where things are at. And this is the challenge I would propose to you in this sort of environment. As I've mentioned many times on the show, bear market rallies have the three S's. They are sudden, they are severe, and they're seductive. And this rally that we're seeing is sort of all three, right? Very quickly coming off of the new swing low. We almost hit 38.50 about a week ago, turning very quickly, closing higher, closing above the open on that low day. And from there, just really pushing to the upside. Days like today, days like last Friday, really showing some resilience with technology leading the way higher, with the market moving up. So the thing to, the encouraging thing is some of the big technology names are working on a day like today. The challenge that I would pose to you from a technical perspective is what has really changed, right? The trend overall remains negative. The chart of the S&P is still making a pattern of lower lows and lower highs. I would be less excited on a day like today as a longer term investor. I would be more excited when that trend changes, when you see evidence that we're putting in a higher low. That is when you will hear excitement bubble up, and I'll be telling you about a potential change in trend. At this point, it shows all the signs of a bear market rally, which is a sudden move out of oversold conditions. A lot of individual names were oversold. The S&P didn't quite make it there in the last week, but a lot of individual names certainly did, bouncing higher off of those lows. That's all super encouraging, but you want to see the trend change. You want to see the price-breaking trend lines, which the S&P really is not yet. You want to see it getting above support and holding it on the next pullback, and I think that's the open question I would have for the chart of the S&P 500. At some point, it pulls back, maybe as early as tomorrow. Does it hold 4,000? Does it make a higher low? If so, then we can start to get encouraged about the potential or the likelihood for further increase in prices. If we fail to hold that, don't look now, but this pattern just continues this downtrend, right, of lower highs and lower lows. So overall, I would argue that the path of least resistance still appears to be down on that medium term to long term time frame. We'll have to see if this current rally continues and accelerates. And again, most importantly, a higher low would tell me to be most encouraged there. Just to finish up here, I did want to I mentioned the dollar chart, so I want to go there very quickly here. We're going to look at the UUP, $USD is our dollar index. I look at the UUP sometimes. It's an ETF, fairly liquid, so it's a good read on what's happening. And if you see the chart of the UUP get this gap lower today, this is after yesterday closing near the lows of the day and pushing downward. What's interesting of the chart of the UUP here is you get higher highs April into May. You get lower peaks in momentum here April into May as well. So this is a bearish momentum divergence where you have the price going higher, but the momentum starts to come out of that market. If you look back in the S&P November, December, January, you have a similar pattern with the S&P making a new high, but on weaker breadth, on weaker momentum readings as it made that last high. That could be the condition we see with the dollar index. Now, the reality is the dollar can come off quite a bit and still arguably be within this longer term uptrend. It's had such an acceleration to the upside. You have to give back quite a bit to get back down to even the 50-day moving average, to get back to the most recent swing lows, which is around 2740, around 2680 on the chart of the UUP, and the dollar index has similar levels of support to pay attention to. So at this point, coming off of it certainly could be the beginning of something deeper. This is when it's important to pay attention to what I'd call the lines in the sand. At what point do you determine that the trend in the dollar really has changed, and what does that mean for your portfolio? Let's take a quick commercial break. We'll be back with today's guest, Ari Wald. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's great to have you join us every weekday after the close as we break down the activity in the markets from a technical perspective. A couple of quick announcements before we get to today's guest, Ari Wald. First off, we welcome your questions. We're going to do a mailbag segment a little later in today's show. We love to feature one of your questions in our next mailbag, which will be on Friday's show of this week. You can get your questions to us one of three ways: via email, thefinalbar@stockcharts.com, on Twitter @finalbarsctv, or on our YouTube channel. Just put a comment below the video you're watching. We'll gather all those questions. Hope to answer one of yours live in the air on Friday's show. Also, go to StockChartsTV.com. That's our on-demand platform. It is completely free. Knowledgeable experts, people like Ari Wald, Mark Chaikin, Larry Williams, many others, sharing some of their investment wisdom and their perspective on these markets in uncertain times. All for free at StockChartsTV.com, or on your mobile device. Just search for StockCharts TV on demand. I want to welcome on today's guest, Ari Wald. Ari's the head of technical analysis at Oppenheimer, coming to us from New York. Ari, it's great to see you. Welcome back to the show.
Oh, Dave, thanks for having me back. What a great time to be on, given the market volatility. You know, I joke that interest in technical analysis highly correlated to swings in the volatility index.
Yes, I was told that my phone will always ring more often in a bear market than a bull market. In my career, I've definitely experienced that. You probably have seen the same. We're starting with your first chart, Ari, which you called cyclical bear and a secular bull. Help us put this current move into context. What is this market telling you?
Yeah, and I agree with your assessment. I think the strength we've seen is should be considered a bear market rally. The question now is how bad are conditions going to get going forward, or I guess conversely, if that was the worst things are going to get. And so to answer that, we like to use history as a guide in conjunction with our read of the tape. You know, with that said, we are assuming that the lower lows we're seeing in the S&P is consistent with a bear market. So we look back to history to frame our expectations. And I want to start with the inset table, which summarizes our bear market stats going back to 1932. And what was interesting is that we found that the variability of the drop was based more on the longer term secular trend rather than whether or not there was an economic recession. This means that we found that recessionary downturns and a long-term secular bull were significantly less damaging than drops without a recession, in a secular bear. For instance, recessions in 1953, 57, 1960, 1990 were all limited to about 20%. So we're highlighting that the median bear market in a secular bull has lasted 7 months and has dropped about 21% peak to trough. So the S&P was down 20% over 4 months into its recent low. So it reached most of the magnitude, and we think now needs a chew up time and build a base. Now, the big if here is whether the S&P is still in a secular bull. I'd argue simply that the evidence isn't great to suggest otherwise. It's just not compelling to suggest that longer term trend is turned. So without getting into that detail, though, it's important for our clients just to understand how we come to our downside projections.
It's very, very interesting. And on a percentage basis, we're sort of at that median level for a pullback in a secular bull market, but not the duration, or sort of under the duration of how long these things have normally taken based on your data there. Your second one, tell us a little bit about the breadth conditions and where you think we're at relative to the bottom here. What are you seeing?
Yeah, getting close. We think we're getting close. So once we have our roadmap, how do we get to the destination? So we put together a 10 indicator market bottom checklist shown in the top right. In summary, 3 out of the 10 have been triggered. Most are near their targeted thresholds, but most aren't at a deep extreme yet either. So we plot our favorite indicator from this list, which is the percentage of NYSE stocks above their 200-day average. Fell as low as 22% last week, which is near territory where forward returns have turned above average. And we think a sub 20% reading would likely signal a final low. So when you add it up, we think it's getting close, but you want to see the base. And we think a final Q3 low is still possible before the midterm year cycle improves in Q4.
It's a great chart. There's so much on this page. I feel like we could just stare at this page for a while and think about it. It's interesting you're seeing that we're not quite there in terms of breadth. And when you show that that chart of the percent above their 200-day, I'm immediately thinking of the 20-some% that are still above it. And it's things that we'd probably guess, right? It's energy and other things like that. So given that sort of overall thesis, given that we may be nearing a bottom, where do you look opportunistically now? Is this a time to just be in wait and see, be in neutral mode? Do you go into things like DVN and others that have had good runs but continue to push higher? Where do you look in this sort of environment?
It's an odd in between here where if typically the last stage is that you even need the leaders to surrender, including energy. So it's difficult to follow relative strength here. Some of those leaders might hold up better, or conversely might be where you want to be coming off the low. But you're still in this in between where they do face that broader market risk. Or do you want to look ahead? We want to look for defensive areas that'll hold up less bad in this kind of continued choppy environment? Do we want to be looking out longer term and start to buy cyclicality now? And so for all these reasons, our 3 favorite sectors are technology, utilities, and materials, for 3 very different reasons and different time horizons. But I think it's that diversity that probably you need given these cross currents in the market.
And it's so funny. I mean, what an interesting environment that we in, that I can assume the thesis you would give in each one of these. You can make a legitimate case for any one of those. Those are very different plays that you're talking about. Ari, listen, it's great to see you. Thanks for coming on the show and sharing some charts. I really appreciate your perspective. Stay safe there in the New York area. We'll talk to you again soon.
Good stuff, Dave. I'll catch you next time. Thanks again.
That's Ari Wald. There is the head of technical analysis at Oppenheimer. And again, I've mentioned a number of times when people like Ari come on the show, if there's something I miss from working at a large investment shop in Boston, it's having guys like Ari that we'd be able to talk to regularly and be able to host at our shop there and talk about charts, because just just a ton of investment wisdom. Interesting. I love his take, that second set of charts. When you look at the observations, this is a common technique we would look at, which is sort of the forward returns given certain breadth characteristics. And if you saw, once that gets below 20% of stocks above their 200-day, the forward returns in the S&P actually tend to be pretty constructive. And that's because those are sort of those bombed out phases. And if you buy out into those bombed out environments, even though it can be challenging to do so, as a long-term investor, usually ends up working pretty well, but not quite there according to some of the charts that Ari was sharing with us. So it was a great take there from Ari Wald from Oppenheimer. Let's continue on with our next segment on this show, the Final Bar Mailbag. As a reminder, we're here to answer your questions. We get many questions and we try to feature as many as we can on the show. Please keep them coming and we'll hope to answer one of yours on Friday's show. Question number one. I have stocks like ATA, AZN, CCJ, even commodities like silver, gold, oil, USO with no earnings showing high negative PEs, or stocks like Shop or Roku with high positive PEs. Also stocks like Nucor or Ford with PEs like 4. Does PE really matter? Shouldn't low PE mean better value or less price fluctuation? So there's a lot to unpack there, and I will bring up one of those stocks. These are not names that that I look at very regularly. ATI is a steel company, Allegheny Technologies, and you can see negative PE ratio, negative earnings, basically. So yes, the number of things to say: should low PEs mean better value or less price fluctuation? Less price fluctuation. No, right? I mean, not necessarily. I mean, it could for sure. But remember, PE is based on two things: the price of the asset and the earnings. It's the price per share and the earnings per share. So essentially, how much are you paying for each dollar that the company earns, right? So a PE of 1 means that for every dollar that the company earns, you're paying $1 for a share of the stock, right? And so higher than that, you're paying multiple dollars for what the company is earning. And usually a growth company with longer term prospects, you would expect a higher PE because you're willing to pay more for what the company is earning now, because you're assuming that you can be looking forward and the company is going to continue to grow. Now, on our platform, when you look at the PE ratio, we're doing it trailing 12 months. We're looking at the last 4 quarters of actually reported earnings and then calculating the PE from there. You can also do a forward PE, which means you're looking at earnings estimates and calculating a forward-looking PE for like the next 12 months. We're working on getting that sort of data on our platform as we build up our fundamental database. So does it mean a better value? Generally speaking, yes. I mean, a lower PE would mean you're paying less for the same amount of earnings. And if two companies are all similar, but one trades at a multiple of 3 times earning and the other one trades for a multiple of 20 times earnings, you're getting in at a better deal by buying the one with the lower PE. Having said that, you've hit on some examples of a lot of problems. Number one, a lot of companies are not earning money, which is why when you look at a lot of speculative technology companies, they don't even talk about EPS. They talk about price to something else. It might be price to cash flow or price to book value or price, EBIT or something where you're basically earnings, but you're stripping out all the things that might be deteriorating earnings. So long story short, yes, earnings can be all over the place. Recently with a lot of the sort of emerging technology names, they don't earn anything yet. They have negative earnings. They're losing money on the bottom line. They're making it on the top. So you look at price to sales, which is looking at the price relative to the revenues of the company. And that might be something you want to look at. Our simple summary page, by the way, has all the fundamental data, most of it that we have. We're working on adding more through the course of this year and beyond. Question number 2, David, I just listened to your interview with John Gagliardi from Fidelity on May 11th. He showed an arithmetic scale chart of the S&P with possible trendline support. Here's a comparison of log scale versus arithmetic scale. And thanks for sending the chart that you were asking about. Let's see, the 2 charts yield different conclusions. Is an arithmetic scale valid over such a long time frame? Yeah, so I very much had that question. In general, I don't try to dig into and nitpick on anyone's process as we're talking or even after. My goal is to try to accentuate some of the best practices. I had that same reaction when John was showing that long-term chart. It really is more of the convention in the industry to look at log scale charts. And that's the top half of your chart here is the S&P with a log scale trend line. What's interesting is look at how consistent the trend line using the highs connects all of those previous peaks, even lining up with the one last year into early this year. This is the chart that similar to one that John showed, which was basically taking it and then showing the accentuation at the upside. The reason why I thought that was fine, though, was John's point was how much that the market had accelerated. And because of a Fed-fueled rally from 2020, 2021 to 2022, that arithmetic scale tells that story much better. You see it on the log scale chart here coming off of the 09 lows, but it certainly is accentuated when you take the arithmetic scale chart. So I think his argument made sense. I mean, I get the argument for the visual. Best practice, though, I think what I would encourage you to do is use log scale if you're looking at anything beyond like a month or two, because in general, log scale charts are a better representation of the long-term trend. stocks don't just magically change percent moves when they get to a higher price value, which is what you're assuming when you look at an arithmetic scale chart. What an arithmetic scale does is it minimizes when something's at a low price and it magnifies or accentuates when it's at a high price. So if you look at the trend since 2009, you can see a remarkably consistent uptrend with some notable laggards there in 2016 and 2020 when it got well below sort of that average. And a regression analysis would be really interesting on that data as well. Next question. I'm new to trading. How can I make more profitable investments in crypto without incurring much losses? This question broke my heart in some ways because I'm getting this question after cryptocurrencies are just deteriorating so significantly. And I don't want to, I will not say I told you so, but I will say that for me and many in the industry that have seen the cycles and have studied bubble characteristics going back to tulip mania and the South Sea bubble, there are so many similarities to what you see around you in an environment like this to what you saw in the late 90s, early 2000s with the tech bubble. And when I see Miami creating a new statue of a bull with the glowing red eyes representing crypto world, I'm immediately thinking this cannot be a good sign. This has to be the sign of a bubble-like environment. And sure enough, in the last 6 weeks, we've seen cryptocurrencies just roll over aggressively. The major ones like Bitcoin and Ether and Litecoin, but also some of the more less liquid ones really got hit the hardest because they in some ways have lost a great amount of their value. So how do you limit those losses? So the answer is you have to set stops when you enter a trade. I did a webcast earlier today for market misbehavior. And one of the habits that we talked about was basically setting your stops at the beginning of the process. Once your position has started to really lose aggressively, that is not the time to be thinking about risk management. When you put a position on, you immediately want to put your stop right on there. In my trading journal for my own portfolio, I would write a trade and immediately below there saying this is where the stop is. I use the alert system on StockCharts to alert when a stop might be hit to make sure that I take the appropriate action. So remember, speculation in something like cryptocurrencies can be totally fine if you remember that speculation involves opportunity for return and also opportunity for risk, opportunity to lose. And so you want to make sure you keep your risk management in very specific attention on something like cryptocurrencies. Limit your losses by determining when you're going to cut and move on to other things. We need to wrap the show, folks. Go to the 3 in 3. Let's go through 3 charts in just under 3 minutes that tell the story of this market environment. We'll start with chart number 1, the dollar ETF, the bullish ETF UUP. I mentioned in our market recap how the dollar had pulled back a bit, just like the NASDAQ bouncing higher on a day like today. Overall, that's encouraging from a tactical perspective. The tactical pullback in the dollar makes a ton of sense because these things have run up so much. Does this really change the trend in the dollar? Absolutely not. Not yet. I mean, it could. And at some point, you have to determine that the dollar index or the dollar is changing trend from uptrend to downtrend. One day like today, and even added on to yesterday's down move, not enough. I would be using trend lines. I would be looking at moving averages and momentum to try to gauge it. But it's certainly something to watch. And the movement is enough to have me start to pay a little more attention to what I'm seeing on the chart of the dollar. The gold, by the way, has been struggling so much in a lot of ways because of the strength in the dollar. Chart number 2, stocks making new highs and new lows on a couple different groups. This is the New York Stock Exchange, the S&P 500, and the NASDAQ going top to bottom. Look at all the new lows in the NASDAQ. Now, you have to remember there's a lot of junk in the NASDAQ, which is like we rarely look at breadth indications using just the NASDAQ. You can see I actually rarely bring it up because by most measures, there are a lot of things that just aren't very good quality companies and they go away, they go to zero. And so stocks making new lows tend to be a little exaggerated. What concerns me more than the extreme number of new lows is the fact that there aren't a ton of new highs yet. And that's what you're not seeing. You're seeing a little bit, but not a ton, right? And so there are very few stocks that have really recovered to the point that the market is okay. So on a day like today, it's super premature to be saying that was the bottom. Although you may be right, it's still guessing at this point. Seeing an expansion in new highs, seeing an improvement in breadth is what can tell you with a little more confidence that that's most likely actually playing out. Chart number 3, Walmart. I think it's an important chart to watch because the gap lower on earnings before the open today puts it right back at the lows from the second half of last year and the beginning of 2022. We failed to hold about 130. That opens the way to get further down to around 124 to around 118. Those are using previous support levels and Fibonacci levels. Pay attention to that chart. Special thanks to Ari Wald from Oppenheimer. I'm Dave Keller from StockCharts.com. Have a great night. We'll see you tomorrow.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.